Good morning once again. Markets have been quite volatile, and so we are always with a question mark in our mind as to what should be our next move and how we should be positioning our portfolios. To answer this question, we have a very distinguished speaker, Mr. Rajeev Thakker, today. Mr. Rajeev Thakker is a Chief Investment Officer for PPFAS Mutual Fund, Parak Financial Advisory Services Mutual Fund, and holds over 2 decades of experience in various segments of capital market, such as investment banking, corporate finance, and securities broking and fund management. He is a qualified chartered accountant, cost accountant, and a CFA charter holder. His association with PPFAS Private Limited, the sponsor of Parak Financial Advisory Services Asset Management Company, began in 2001. He was appointed as a fund manager for the erstwhile flagship scheme of the portfolio management services titled Cognito in 2003. He is a strong believer in the school of value investing, and he is heavily influenced by Warren Buffett and Charlie Munger's approach. Apart from his technical ability, what distinguishes him from many others is his ability to stand his ground and remain unflappable during the difficult times. He is a regular contributor to Mint newspaper, as also appears on business channels such as Bloomberg TV and ET Now. Let us welcome Mr. Rajeev Thakker to share his wisdom and enlighten us on investing with today's topic on asset allocation in current environment. But before I hand over the stage to Mr. Rajeev Thakker, we'll like to felicitate him. I'll request Mr. Sujit Vaingankar to hand over the memento. I will now request Mr. Rajeev Thakker to take the stage. Thank you so much.
Good morning. Thank you for being here, and it's wonderful interacting with astute investors of the association. This is my second visit here as a speaker. So as I was mentioning, I think around 4 years back, I had come at the Pula Deshpande Hall. The event was held at that venue. There is some topic, there are some presentation slides, but those don't really matter. I was aware that this is a small gathering. We can talk about what is there on your mind, whatever questions that you have. And there's not too much of structure behind the presentation in that sense. So as an icebreaker, as a beginning, we could go through these slides, but then I'm happy to discuss whatever questions you have. We spoke about market volatility and things like that. Ultimately, when we look back at our financial journey, how much money you allocated to growth assets? Were you forced to liquidate your growth assets at low points because of lack of emergency corpus or a medical emergency or something like that? Did you have adequate health and life covers? In retirement or whenever you require cash flows, is your allocation appropriate? I think far too much attention is spent on which stock to buy, when to buy, how quickly it will go up, what will Donald Trump do, what will the new RBI governor do, what happens because of the overthrow of the government in Syria. We place far too much importance on those aspects rather than really looking at the important factors which will determine our financial journey, and that is the asset allocation. It's mostly about asset allocation. Rest all is mainly noise. So what will drive your asset allocation? I don't think anything of this will be new to the people in the audience, but it's worthwhile saying this. The age matters a lot. Today, if someone is dependent on the savings that he or she has made over a lifetime and now depends on that corpus to get a regular monthly income, then telling that person put all your money in equities is very, very foolish thing to do. But if there's a young 20, 21-year-old person who's joining the workforce, has a very, very stable job and a regular monthly income, for that person to put bulk of the money in PPF account or bank FDs again is very, very inappropriate. So one is age determines what should be your allocation, what should be there in the investments that you have. At the same time, the personal circumstances also matter a lot. Someone having a government job can afford to take higher risk on the investment side. Someone who's dependent on acting assignments, which may come, may not come. If it comes, it results in a big inflow. Then there could be a fallow period for 6 months, 12 months where there's no work. Then such person will have a very risky professional career. But then investments should balance out by being low risk. So personal income, expenditure, how much assets you have, how much liabilities you have, that matters a lot in terms of where you put in your money. Again, goals matter. So as I said, are you really saving and investing for long-term wealth creation, or are you trying to generate a regular income out of the cash flow? Again, the Western concepts may not necessarily apply in India. In the West, there's a very simple formula people have for asset allocation. Take 100, reduce your age, balance money is your equity allocation, remaining should be largely fixed income allocation. Why does that not apply in India? In India, some people have a Western way of thinking and use this formula, very good. Some other people have a family approach to wealth. They are not looking at spending all their savings in their lifetime. They look at their children as a unit, in which case, when someone is older, you only require a nominal amount of income from the assets, and bulk of the corpus is going to be passed down to the next generation, in which case the allocation can be very, very different. So what are the goals, what is the method of thinking that people have towards money, that also matters a lot in terms of how the allocation is to be done. Some people lose their sleep every time the Nifty and Sensex go up and down by 1 or 2%. Losing sleep is not worth it. Maybe even if you get a little bit of lower return, be in safer asset classes. Some people are comfortable going through the ups and downs. They realize that if you hold on to these volatile assets, things like equities, over periods like 5 years, 10 years, they end up giving far greater return. But in between, there will be scary moments. If someone is comfortable with that, then also the allocation can be higher towards the riskier assets. And again, there would be individual circumstances in everyone's lives. Some people may have special children who require care, and some trust may need to be created, or some people will have children, some people will not have children. In certain cases, the spouse may have separated. So there could be various unique factors in an individual's life or in a family's life, and those also need to be kept in mind while deciding on the allocation. This is a background. I guess everyone is aware of these things. The asset allocation will largely be driven by these factors. So the current environment will only play a role at the margin. It's The current environment is not going to change your age, is not going to change your risk profile, is not going to change your goals. I'll be talking about the current environment only in relation to what is happening with equities, what is happening with bank deposits and bonds, what is happening with gold, a little bit about international markets. I'll be talking about those things. A few, so a few years back, interest rates were so low that people were forced into things like equities. Bank FD rates had fallen to 5% and thereabouts, and it was really a bad time for people depending on things like bank FDs for regular returns. That scenario has changed now. So today you have RBI floating rate bonds, which for an individual give 8% plus returns on a 6-monthly basis. So 4%, 8% on an annual basis. Interest is paid out every 6 months. So you have these kind of instruments. Don't be driven by the scenario as it existed 3-4 years back. Interest rates have moved up. Interest rates are reasonably attractive. If your situation is such that you don't have the risk-taking capability, or where you are overexposed to equity because of past situations, now is a good time to reallocate money towards fixed income securities. Rates are reasonably high. Equity as an asset class, lot of older people in this room, people who have seen various market cycles. But in the market, we have a lot of 20-year-olds who have come in the last 4-5 years and who have never seen a down market. And market, every time it falls 5%, 10%, people rush into purchase. They haven't seen the period of, let's say, something like 1992 to 2003, 11-year period in equities where markets at the index level gave negative returns. At Harshad Mehta time, index had gone to 4,200 or 300 thereabouts. March of 2003, index was at 2850. This is BSE Sensex. So from 4,200 to 2850, 11-year period where you made negative returns. Even if someone entered the market December 2007, there was a long period where the stock markets were not giving you decent returns. So today, if someone is coming to the equity market thinking that, okay, equity will go up and down on a day-to-day basis, week-to-week basis, but if I stay invested for 1 year, it should give me 20% return, 25% return, 30% return. Equity does not work that way. Our northern neighbors, China, after 30 years, equity has given less than 1% return per annum. And it's been an economy which has grown in terms of GDP. They have dominated a lot of sectors in terms of consumer electronics and now increasingly electric vehicles, solar energy. They have made tremendous progress, bullet trains, but still their stock market has not delivered. In Japan, for again 25-30 years, stock markets give 0 or negative returns. So stocks are not risk-free. That is one message I want to convey, and it is important to convey this today because the market has been giving positive returns year after year, and people tend to forget this. They tend to forget the past history and look at only the recent period and then they tend to extrapolate. This is also distorting the return expectations that people are coming to the equity markets have. So if bonds are giving you 8%, how much should equity give you? Maybe something like 12% in the long run. Expecting something like 20%, 30% kind of thing is very, very risky. Sometimes by fluke, by luck, you may end up making that kind of money, especially if you have bought at very attractive levels in a crash, something like a post-COVID period or something like in 2008 or 9, then you can make very, very high returns for a short period of time. But otherwise, longer term returns, it's very, very risky to assume very high numbers here. So this is not really about a investment asset class, but it's about a asset class which takes away bulk of our money, and this is real estate. For most people, one of the biggest expenditure that they make in their lifetime is their primary residence, and some people even have an ambition of buying real estate as an investment. So what happens is people get drawn in to buying an asset. One, either people buy under construction assets which for some reason or the other have difficulty in completion and then regret their purchase. The second regret can come on account of thinking that this area is very promising. They purchase something and then that area goes out of favor for whatever reason and the returns are not as per expectation. The third mistake sometimes, especially culturally, Indians make is this love for owning your primary residence. People tend to buy a house relatively early. These days, corporate jobs are not certain. Today, someone is working in Mumbai. 2 years later, that person may be working in Hyderabad or maybe working in Bangalore, maybe working for a different company. Some people may want to go abroad. So if your life stage is not certain, if you are not certain that you want to build roots in a particular city, in a particular locality, it does not make sense rushing your primary residence purchase and buying that too early. Also, at the early stage of the career, there may be different requirements. A single person will have a different requirement for a home as compared to someone who's married. Someone with children will again have a different requirement as compared to someone who's newly married in terms of the size of the apartment, in terms of the number of rooms that you require. And each time you buy and sell property, there are transaction costs which damage your financial decision in terms of buying your primary residence. Also, not just in Mumbai, all over India, various cities, you are having this rollout of public transportation in terms of the metro rail network, in terms of we are seeing the coastal road, the Trans Harbour link. So, what was an erstwhile an area which in the earlier scenario was in the wilderness suddenly becomes very, very accessible once the public transportation comes in. So sometimes you may get good residences, good offices if you really look around and figure out what area which was earlier not accessible is now accessible, and you may save significant amount of capital cost in terms of exploring those alternatives. Again, in India, people have this love for real estate. One of the reasons is historically it has been an avenue where people could park their untaxed income, where transactions would happen in cash. Increasingly, that is no longer the case. So if you have money in the bank and if you are exploring investing in a real estate kind of asset class, there are these new asset classes in terms of real estate investment trusts, where if you buy the units of those REITs, effectively you end up owning a diversified portfolio of commercial real estate all over India. So some of the offices will be in Bangalore, some may be in Pune, some may be in NCR region. And the tenants are high quality tenants. These are global players like Accenture or Deloitte and KPMG, and those kind of companies are the tenants, and you get regular cash flow to the REIT, and they in turn pay out the money to the unit holders on a quarterly basis. So not only you get regular income from these investments, as the real estate prices increase over a period of time, those REITs hopefully should also appreciate in value as the years go by. For most people, I would recommend that you stay away from fancy stuff. So Bitcoin has crossed 100 lakhs per Bitcoin and people get excited by that. See, essentially, Bitcoin has been created by a group of IT enthusiasts who came together, and it was created out of thin air. Now, some people argue there will be only a certain number of Bitcoins, whatever 21 million or whatever the number is, and further Bitcoins will not be created. So it will be valuable, it will replace currency and gold and things like that. I don't know whether that will happen, not happen. Today's talk is not about Bitcoin. My thing is, if there is no regulated way of you buying these things or selling these things, there's no clarity on taxation. In fact, taxation could be adverse to that. There's no inherent cash flow. There are no FDs of Bitcoin effectively. So what you are depending is what will be the price someone else will be willing to pay for this 1 year out. So try and completely stay away from fancy stuff. If at all you want to go into fancy things, allocate a very small amount of money which you can afford to lose and not worry too much about it. Lot of different things will keep coming out, and in most cases people end up losing money. Gold, as such, gold is a asset class again where there's no inherent income from gold, because if you have 10 grams of gold, after 10 years also it will be 10 grams of gold. Unlike a bank FD, it's not going to give you interest. But interestingly, what has happened is, when Russia and Ukraine started fighting, US has tried to impound Russia's gold reserves, dollar reserves. What that has resulted is, people are now not comfortable enough owning a large part of the foreign exchange reserves in US dollar. People are saying we would rather keep our country's reserves in something like gold instead of depending on the US control of the financial system. So China has been buying gold, Russia has been buying gold, Indian Central Bank has been buying gold, and not only buying gold, you would have seen the newspaper article where we have transported the gold physically from UK to our shores. Why do we want to keep our gold in a foreign country? If there's ever a conflict kind of situation, we want our reserves in our country. So that is resulting in this demand for precious metals, things like gold and silver. So depending on personal preferences, some small allocation could be considered in that asset class. So that's all I wanted to talk about the current scenario of the various assets that are there, and happy to take questions that you have. So barring names of individual companies that you should buy or sell tomorrow, everything else is fine.
I would like to ask a question.
Sure. Sure.
Audience. You mentioned about asset allocation, and you said, equity is always not going to be in favor. And there have been periods we spoke about it last 25, 30 years for a decade together, there was a negative return. The biggest dilemma that a person faces is that if he does a bit of allocation to a fixed income, he feels that there's lots of opportunity on the equity side. That is one biggest dilemma. So if I put some money in fixed income or some bonds, and after 3 years I'm back, I see that okay, I had invested in a equity in form of a mutual fund or whatever, but I would have earned more as regards the fixed income. That's one dilemma. If you would like to throw some light on that, and what's the best way forward? I mean, there are new asset classes coming out within the mutual fund, like commodity assets. Like,
sure. That is a very interesting question, and I'll answer this with a phrase which sounds very, very counterintuitive and which at least I liked very much. So it says, brakes make a car go faster. It's counterintuitive, right? It should be accelerator makes the car go faster. But no, the thing is brake makes the car go faster. Because if a good quality brake is not there, you will not go fast, because then you can't stop the car if some obstacle comes up at a given distance. If your brakes are worn out, then you will keep a far extra margin and you will want to drive very, very slowly, so that after you apply brakes, maybe the car will still go 100 meters ahead. In March 2020, we saw so many people being forced to sell their equity shares, being forced to redeem their equity mutual funds. The reason is that at that time, when it was very attractive period to actually buy equity shares, people lost their jobs and people had no income, or even if they had a business, let's say someone had a restaurant business or a hotel business or a tourism business, everything was shut. Now, if your income stops, then you have to dip into your savings and investments to meet your expenses. To avoid this kind of situation, everyone should have some kind of a safety net, emergency corpus or some allocation to debt. So I would say that equity is a great asset class for wealth creation, but some amount of debt allocation will allow you to stay invested in equity. So that is one point I wanted to make. Again, for a young person today with a very, very long runway, I would recommend that bulk of the money should go in equities. For a retiree, looking back and saying, if only I had invested more in equities, I would have made more instead of getting the 8% in bonds, I think that is a wrong way of looking at it. Someone will always be getting richer faster than you. So, Mr. Mukesh Ambani can either feel happy that he is among the top richest Indians, or he can feel envious of Elon Musk saying he is richer than me. So, someone will be getting richer than you all the time. That there's no shame in someone else becoming richer than you, or missing out on hypothetical gains. So if you are invested, let's say 70% in equity and 30% in bonds, one of two things will happen in future. Either equities will do better or bonds will do better. But you are participating in both asset classes. Thinking that this 30 also I should have invested in equities and potentially made higher returns, that becomes, so 100% equity allocation becomes very, very damaging to most people. Now, I know some people have done it and managed with that, but I would recommend some mix and having some kind of asset allocation. The newer scheme categories are very, very interesting. So, I missed out including that in the presentation. I'm glad you asked this question. any asset that you invest in, bond, equity, gold, real estate, any asset, while you are in the saving stage, try and make sure that you don't pay tax on that income. How can you do that? Perfectly legal ways of doing it. If you are young and saving, putting some money in fixed income securities, put it in PPF instead of doing a bank FD, because that money will come to you after retirement, and till that time you don't pay tax. Or put money in debt mutual funds. Ultimately it will be taxed, but put it in the growth plan because it will keep growing in NAV while you are earning, while you are paying tax on your monthly salary or business income. At that time you don't have to pay tax on your investment income. So NPS, EPFO, PPF, mutual fund schemes, all these are wonderful vehicles where you can let the money compound tax free, and later on you can figure out taxes after your regular income stops coming in, and then you have to consume from your savings in retirement. One of the recent tax changes has made debt mutual funds a little bit unattractive, because earlier you had this long-term capital gains tax benefit and indexation benefits. That has gone away on pure debt mutual funds. So now things like hybrid funds and things like multi-asset funds, wherever the debt component is less, those kind of mutual fund schemes have become attractive, because if you hold these kind of schemes for a period of 2 years, you will pay 12.5% long-term capital gains tax instead of having to pay tax at your marginal rate. So those are good vehicles to explore.
Sir,
Yes.
what about this sovereign bond now? Government has stopped issuing
Sovereign gold bonds?
sovereign.
Yeah. I think there is a thought behind stopping that. They haven't been issuing new ones.
And whether they will be interesting redeem earlier than what was the period you mentioned. There was an article.
I am not very updated about this.
I think, yeah, we'll leave that question because out of syllabus for this.
No, so yeah, maybe, meaning whatever is the media report, I think that would be the last update on that. I haven't really.
Fresh bonds are not coming.
Fresh bonds are not coming, that's right. So earlier it was thought that gold is a dead investment, and in fact for many years the central banks were selling gold. So RBI or Central Bank of Russia, China, all these people, Middle Eastern countries, they were not buying gold. Now suddenly they have started buying gold. Now to firstly pay the appreciation on gold, where the underlying value of gold itself is increasing, plus to pay interest on that, the government has realized it's not a very good thing to do. So the capital gains were tax free if you held to maturity, and the interest income was taxable. Yes, please.
In new income tax rules, they have a regime 1 and regime 2. And most of the people follow regime 2, and government also wants to encourage that. They want people to spend and not to invest. Now, PPF was a very good instrument to save because you used to get a good tax benefit and 8% interest. But now, since that option is not there, do you recommend to make the investment in PPF?
PPF, to the extent you want a fixed income allocation, PPF is still a wonderful instrument. Even if you are under regime 2, you will not get that ATC benefit, the 1.5 lakh benefit. But the interest on that income will not be taxed, even under regime 2. And at maturity, you will get all your proceeds. So, the downside of PPF is you don't have liquidity. So in between, if you want to access that, there's a waiting period and then you can withdraw only a certain amount. But otherwise, if the objective is to compound money and not touch it, then it still remains a attractive investment option. Yes, please.
As PPM is concerned, once you complete the 15-year period, they allow annually one withdrawal of a full amount. So that tax-free can, after retirement, we can continuously withdraw.
Correct. That's
Very important.
yes.
NP and REIT. And in mutual fund space, many there is specific kind of elements for this product. What is the reason for that? Because according to me, people who are looking at fixed income at the same time, appreciation little bit of the thing is missing out.
Yes. So mutual fund industry is keen to launch products. SEBI is also keen on encouraging this investments in this asset class. The only challenge has been that these instruments have come only over last 3-4 years. So earlier you had 0 REITs, then you had 1 REIT, then you have had 2 REITs. Now there are 4 REITs which are listed. As a sufficient number of REITs and InvITs are there, you will have mutual fund schemes being launched to invest in these assets. Earlier, let's say if there's only 1 REIT listed and you come out with a mutual fund scheme, all the money will go in only 1 REIT and liquidity was not that much. So my expectation is within next 12 to 24 months, you could see schemes coming up for this. Yes, please.
Take on investment in UAE.
So most experts in personal finance will recommend segregation of risk cover and investment. So ULIP is a combination of life insurance and it's a combination of investment. It typically becomes more expensive for the investor in terms of higher expense charges over the life of the investment, and also life cover is reduced to that extent. The best life insurance cover to take is the term insurance, where you pay a regular premium, and if you survive the coverage period, then you get 0, nothing is paid to you, but which is a good situation to be in. If you have taken a car insurance, you don't hope for a car accident. You are happy if at the end of 1 year there is no accident and the premium was giving you mental peace. Same way, term insurance, you pay the premium and you hope that you never have to encash the insurance policy. Whatever rest of the money you save on premium instead of buying a ULIP, that money should go into pure investment assets, things like mutual funds or bonds or equity assets or REITs, InvITs, whatever else that are. Yes, please.
We talk about asset allocation. If somebody wants to invest, say, in this market, like recently funded ETF, there are not many funds or they don't accept fresh funds. So is Parag planning to introduce any type of funds?
So that's a very, very interesting point that you make. I missed out in the presentation. Thank you for that. International diversification is very, very important from a portfolio perspective, and the common misconception about international diversification is that it's only for the rich. Oh, only crorepati's or people who are billionaires should look at international investing. Why should we bother? Our investments are very, very limited. See, what international diversification does is that while global events will impact your portfolio, local events impact will get mitigated. Now, if there's a sudden demonetization in India, or if China becomes very aggressive on the borders and we have a tussle with China, or if we are undergoing some transformational change in terms of GST introduction and that causes business uncertainty for a certain amount of time, All these factors affect only in India. They don't affect the global markets. So when you have Indian equities plus global equities, that reduces the up and down in your portfolio very, very significantly. Also, there are many opportunities which are not available in India. So today, I think everyone in this room would have a smartphone in the pocket or in the hands. These smartphones will either be Apple or Android. I don't think any third operating system would be there. Now, Apple is a US company, Android, which is made by Google, is again a US company. Today, when we are having 4G and 5G telecom services, typically among the apps that we use WhatsApp, Instagram, Facebook, we use YouTube, we use Google, we use Amazon. All of these are foreign companies. So, to diversify abroad is a very, very important aspect of asset allocation and investing in equities. As sir mentioned, the challenge for Indian mutual funds has been a limit which has been set by RBI, which is $7 billion. Now, this $7 billion cumulative for mutual funds is not an annual limit. It's a one-time limit. Once you exhaust that, mutual funds cannot accept any more money to invest abroad. Now, this comes to, in a country of 1.4 billion people, it comes to $5 per person. Right? So, the limit is very, very less. On the other hand, as an individual, every financial year, you can remit 250,000 US dollars abroad for investment purposes. So, as sir mentioned, most mutual funds in India have stopped accepting money for overseas investments. My recommendation is watch out, as in when some small window opens, you should try and invest in mutual fund schemes investing abroad. That is one option. Do not buy ETFs of foreign mutual funds on the exchange, because those are trading at very huge premium to the underlying NAV. It's only when mutual fund houses open the window, if they have seen some redemption, they allow some small investment. If that window opens, you should go and invest in those and get some allocation to overseas units. Otherwise, the only via media is using the LRS mechanism or liberalized remittance scheme mechanism, the 250,000 US dollars that I spoke about. It's not easy. There are hurdles. When you remit money outside, let us say you remit $10,000, apart from paying money for that $10,000, you have to pay advance tax called TCS, tax collection at source. 20% you have to pay to the government, because it's presumed that everyone remitting money outside is a tax evader. You have to prove that you are innocent by paying that and then filing return and all that, which is a hurdle. Banks charge you hefty commission for remittances going out, coming in. Direct US stock investment, beyond $60,000, there's a heavy inheritance tax issue. So if someone has $1 million worth US stock and that person passes away, the inheritors will get only 600,000 US dollars. 40% money will go away. So again, that is a hurdle. So there are plenty of hurdles, but still it may be worthwhile for a few people. Use LRS, remit money outside, buy mutual fund units of domiciled in some place like Ireland or something, which are called UCITS, which invest globally. Ireland does not have any capital gains tax. Ireland does not have any inheritance tax. All tax you will pay will be only in India. So you have to worry only about your home country, which is India. So it's worthwhile exploring these opportunities. About our own plans, we are working on setting up a fund in Gift City, which is equivalent to a foreign jurisdiction. Still, you will have to remit money via LRS, pay the TCS, but then the problem of inheritance tax and going to Irish mutual funds and all, that is avoided. We are working on setting up a structure in Gift City. It will take time, maybe 6 months, 12 months. Yes, please.
Just a little digression I'm doing. If you look at the wealth inequalities index, India is the worst and along with Africa it is competing. The top 1% controls 40% wealth and top 10% controls 77% wealth. You are talking about the inheritance tax and wealth tax. If your personal view, should it be taxed?
There are people like Warren Buffett and Bill Gates and all who have this very, very interesting philosophy. They put it like this. They say you should give so much money to your children that they can do anything they want in life, but you should not give them so much that they do nothing in life. Right? So, there's a good middle path that one has to arrive at. So, if we go into total communism kind of mechanism where the society owns all assets, then there's no incentive for someone to work hard to create wealth and things like that. At the same time, if we have the other extreme where only 0.5% or 1% of the population controls all resources, that is also not good. I think at the first level, we need to bring all the undisclosed income into the public domain. So, while we say only this percentage of population controls this much, these are typically businessmen who run listed companies or who have organized businesses where they pay proper tax. Rest of the people are huge landowners, people who have safes full of gold, people who have Benami assets, foreign assets. First step is to bring that in the tax fold. And some kind of moderate taxation on estate duty, inheritance tax, down the road may not be a bad idea. I think somewhere in between should be a golden path. Yes, please.
Specifically about your flexi cap, international investment and ICT actually nearly 12.5% in foreign assets. So about the seeding which you talked about, so is that moving SIP or still have you exhausted that limit or some are going that like micro stocks or other?
Yes. So the stocks that we own abroad, whatever dividend we get on that, we can reinvest. We can sell something and buy something else, but we cannot send more money from India because the limit has been exhausted. If you buy units today, you will get 12% allocation to foreign stocks because the portfolio is the same for new investors and old investors. So people who are investing today get that small allocation. We cannot now remit more money outside. Yes, please.
In your earlier reply, you were saying that that window will be kept open and that regulations to that extent that limit is reduced. How will one can also know if one is a regular investor that perhaps I then because that window will be open so that additional funds can be deployed?
So in Parag Parikh FlexiCap, that window is not going to open. So we have never brought money back, so we will not send money back. So ours is a blended thing, India plus foreign stocks. That window opening I was specifically referring to about people who are 100% investing in foreign stocks. So in between, the taxation regime had become very, very adverse on these schemes. So tax was at maximum marginal rate and no long-term gains were allowed in the tax return. So at that time, some fund houses had a redemption. Specifically, the business paper Mint or the online website livemint.com, they had run a story of which all schemes are there. Most of the schemes were closed. They had listed 2 or 3 schemes which are still accepting money. This is within the last 3 or 4 days. So you could look up the article and invest wherever the limit is still open.
I like that question.
Yes.
So actually, election last year, we felt that the economy was running, and it was running, and the markets were also running. After September, I think things have taken a different kind of. One is, I think corporate earnings have got a bit of setback. So would you like to elaborate something over that, and what's the way forward for it, if that's.
Yeah. This is a pet subject of mine, so just stop me whenever you think I'm talking too much, because I can go on and on this subject. A lot of times people confuse GDP growth or economic growth with corporate profits and stock market returns. In a closed economy, in a economy where growth was not that good, a company like Bajaj Auto was doing very well. It had those Chetak scooters for which you had a waiting period of 4 or 5 years. And when economy opened up for a brief period of time, they had a lot of difficulty. All the Japanese players came in and they lost market share and all of that. So, country's growth may not necessarily result in corporate profit growth, that is one. In 1990s, Indian Airlines had a monopoly on domestic air travel. Later on, the skies were opened up for private sector airlines. So you had Modi Luft, Damania Airways, East West Travel Trade Links, NEPC Airlines, Air Deccan, Air Sahara, Kingfisher Airlines, Jet Airways, and numerous others who I don't even remember now. All these people came in and all these people went bankrupt. More planes flying, more crew being recruited, more passengers doing a lot more tourism, more business travel happening. Is it contributing to GDP growth? Yes. Is it contributing to corporate profitability? Answer is no. Will it generate returns for shareholders? Answer is no. MTNL had monopoly in Mumbai and Delhi. BSNL had monopoly on the rest of the country. Private sector telecom players were allowed entry in 90s. Only one company survived of that era, which is Bharti Airtel. Rest all went bankrupt. Did it create enormous wealth for shareholders? Answer is no. Again, China, 30 years, per year return is less than 1%. So after 30 years, absolute return is some 20-25%. If you had put $100, it is worth $125 now, after 30 years. Tremendous amount of GDP growth. So with GDP growth, what are the other things that are required? The other thing that is required is less competition. The other thing that is required is good management quality, pricing power, balance sheet strength. Two retailing companies, COVID hits, one retailing company, terrible balance sheet, lot of borrowings. They had to sell out their whole business. It's now no longer around. Aditya Birla Group came and bought most of the pieces. The other retailing group thrived in COVID, robust balance sheet. Again, when big retailers are spreading wings, when e-commerce is spreading wings, when you have 5 to 10 companies competing in 10-minute grocery delivery, when you have direct-to-consumer brands, when all are competing, who will make money? Consumer is definitely benefiting, but will it result in profits for the corporates and shareholders? That's a question mark. So, I spend very, very little of my time analyzing the GDP growth data or macro. More time is spent in evaluating individual company and its prospects and how the business environment looks like. I think the inherent inherent advantages continue for India as a country. We have a large pool of skilled human resources. That work is not going to go away despite all the hype around generative AI and all. Generative AI will make the developers more productive in some aspects, etc. But saying that, okay, this bank is to be computerized, I'll open ChatGPT and just put in a prompt computerize State Bank of India, it is not going to automatically do that end to end. There will be people required to go through the AI generated code, fix it together, debug it, and a lot of work goes into it. One of the things which is dampening the growth is that global companies have realized the fact that India has a lot of talent pool. They are setting up their own centers here. So for example, American Express has the largest building which they operate world over in Gurgaon now. So rather than US having a big building where most employees are there, their Gurgaon office will employ the maximum number of people. So same story you see in Thane, you see in Pune, Bangalore, Hyderabad, Chennai, Gurgaon. All these places you are seeing what are called GCCs coming up, global captives. So these big four accounting firms, Ernst & Young, PwC, KPMG and all those kind of companies, they are employing so many accountants here. Like on Western Express Highway, Morgan Stanley has taken huge amount of office space. So a lot of these are working for their foreign offices. So to that extent, the outsourcing opportunity reduces, where the global companies set up the captive centers here. But in many cases, they have realized that it's too much of a hassle. Sometimes the global captives are as a joint venture with Indian IT companies. And sometimes after running it for 2, 3, 4 years, they get tired of running it and they sell out the operation to a Indian IT company to run it. So I think broadly, things should be okay. Yes, please.
Next year, over 8 to 10 AMCs coming on with green energy and what's the take on this particular sector?
So I am not a very big fan on sectoral funds or thematic funds. Reason is, today that sector may look attractive. If tomorrow something else looks attractive, your mutual fund scheme should have the flexibility to invest wherever the opportunity is. So I am not a big fan of sectoral funds, but specifically talking about the sector and outlook, 100% green energy will play a big role in India and world over. To some extent wind, to a larger extent solar. These energies are becoming very, very cost efficient. They are good for the environment. That is one good part. Second is they are cheaper than coal-fired power plant increasingly. Both are good factors, so why would anyone set up a new thermal power plant? Will these companies make a lot of profit? That is a question mark. So like we discussed, airlines and telecom companies in the 90s, everyone knows green energy is going to see a lot of growth. A lot of people are entering the sector. The solar module prices are crashing year after year. Battery prices for utility scale energy storage, those are coming down. Wind turbine costs are falling all the time. Volume growth is there, but prices keep coming down. Now, will someone make huge amount of money or not? Only time will tell. The same excitement that we have today for renewable was also there in 2006, 7 or thereabouts. One windmill company had become very, very popular at that time as well. And then had to go through a tough time. They've again rebounded now. But point I'm trying to make is, let us say if I am making solar modules and he's making solar modules, ultimately the product is the same. There's nothing like a brand value that this thing has. It's a commoditized thing. Ultimately, who will get the order will depend on who quotes a lower price. And there are a lot of people entering the sector. So we have seen this in telecom, right? Earlier, 1 rupee per minute call, then 50 paise, then people will say per second billing, 1 paise per second. It became a price game, and ultimately all of them lost out. So we are watching the space, but I'm not so sure that it's a great idea to rush in and put all the money into a green energy fund. Yes.
Take care of these fluctuations, momentum funds, quant funds, that sort of thing. How about actually investing in that?
Sure. So quant funds, there are two things. There's one mutual fund house called Quant, and there's a strategy called Quant strategy. So I'm talking about quant strategies, which are launched by various fund houses. So quant strategies, and specifically you refer to momentum. So momentum is one of the strategies that can be run. There are various quant strategies, and there are various indices covering these quant strategies. So there is something called a low wall strategy, or there's something called a quality strategy. There is something called a value strategy in a formulaic method based on quants, and there's a momentum quant strategy. Essentially what momentum says is, if a company has seen a stock price increase over the last 12 months, then it is likely that over the next 1 to 3 months, the stock price will continue to rise. Now, this phenomenon we see in day-to-day world as well. If a car is coming at 100 kilometers per hour, then even if you apply the brakes, it will still go ahead in the same direction. Suddenly it will not go back. So what this strategy does is, it goes through all the companies and sees which are the companies which have had the maximum increase in share price, and the fund will invest in those companies and periodically keep shuffling the portfolio. It works well in the past, but it goes through tremendous amount of drawdowns as well. Globally, these funds have existed for a long period of time. So think about it. If you were running a momentum strategy in 1992, your scheme would have names like Mazda Industries, your scheme would have names like ACC, right? The Apollo tires, things which were in maximum flavor. But then when lower circuits start hitting, then people may not have a exit. If you were running this strategy in 2007, then or in 2000, if you were running it, then all the Ketan Parekh K10 stocks would figure in your momentum portfolio. If you were running this in 2007, then your portfolio would consist of real estate companies and infrastructure companies largely. It looks very, very promising on the way up, but the drawdowns can also be very, very severe. And across cycles, it is one among very many strategies that are out there.
It was not new AI tools to forecast.
Yeah, people are making attempts. Obviously, people are trying various things, and to what extent will it succeed, we have to see. Again, a lot of these people run what are called black box strategies, meaning to an outsider, you don't know what is happening inside that box. So, for example, one of the most successful houses globally is a company called Renaissance Technologies. This is in the US. It was run by a mathematician called Jim Simons. He passed away recently. They would not employ any MBA finance, chartered accountant, CFA, those kind of people. They would employ people who were great mathematicians or people who were great in fundamental physics. Some of the people, in fact, were, and this is not a joke, I am not making fun here, they had alternative career paths. One is continue physics research and win a Nobel Prize, or join Renaissance Technologies and make money. So they have had Nobel Prize winning caliber people, physicists working in the firm, and they have in the past generated on a limited capital pool returns as high as 60% per annum compounding over long periods of time. But how do they do it? They don't tell the rest of the world. They don't want their formula to go out. So maybe someone is successful right now and doing something. Who knows?
Sir, this index fund, can you put some words on this algo, which is available for retail?
I'll talk about that. Yes.
Index funds. There's security funds run by all the people. And by and large, everybody tries to match or supervise and supersede that particular thing. So I'm just thinking about it. For an ordinary investor, how much should we take index fund funds besides putting up in the mutual fund? Because out of 10, so 3 or 4 will be better outliers, the remaining one will be laggards on it. So what is your view?
Sure. So algo is very, very simple. Algorithm means rule based. You could have any algorithm. Your algorithm could be that if the stock price crosses, let's say, 200-day moving average on the higher side, you should buy. If it falls, you should sell. Now the computer will continuously, second by second, keep looking at that, and based on the rule that you have given, it will apply it. Another algo which most people would have heard about is a stop loss. That is also an algorithm. I have bought the stock at 100. My stop loss is 10% lower than my purchase price. If the stock price falls below 90, automatically sell it. So algorithm is nothing but feeding predefined rules into the computer system based on which the transaction will happen. There's nothing, and you can have simple algorithms, you can have complex algorithms. So brokerages have been allowing this. SEBI has put out some consultation on this, and hopefully this will be open to retail investors as well. But be very, very careful. Like in computer it is said, garbage in, garbage out. If you put a wrong algorithm, it will give you wrong results. If your algorithm is good, it will give you good results. About active investing versus passive investing and how much to invest in each fund. So let us do a thought experiment. In the Indian equity space, there are 3 promoter groups. One is private business families, second is government, which is PSUs, and third is MNCs. Let us say this side is the promoter group who own 50% of all the companies which are listed. This section is the passive group which has 25% of the market cap of all the listed companies. And this section collectively owns the remaining 25% of the market cap. Now, here everyone will have the same portfolio, uniform portfolio, no distinction, because these are index funds, passive funds. You will buy in proportion of free float market cap of every company. Here, all of them will decide which stock they like, which fund they like, and all of that. So let us say he is very bullish on Reliance Industries. He is very bullish on State Bank of India. He is very bullish on Airtel. So everyone will have different portfolios. Total results of promoters of index funds and of active funds will exactly be the same because they have the same portfolio, right? Here, Promoters will of course pay zero management fee. Here, Nifty 50 index funds, you have as cheap as 0.04% per annum. Whereas actively managed funds will have some expense ratio. So as a group, they will earn less than active investors as a group, they will earn less than the passive funds. But within the active group, there are retail investors, there are PMS managers, there are AIFs, NPS, all sorts of mutual fund managers, everybody is there. The variance between the worst performing person and the best performing person will be huge. So if you can identify a strategy or a manager or someone who will do well, then you could get better returns even after the expenses. But if you add up everything, then or if you are going to buy all the sectoral funds and all the mutual funds that are there, then you would be better off buying an index fund rather than do this. So ultimately the strategy that a algo or a manager or a fund or a PMS, whatever you call, that should make sense. You should give it time. So even the best strategies will go through periods where they do not seem to work. They work across a cycle, not on a day-to-day basis. Whether you follow momentum, whether you follow technical analysis, fundamental analysis, everything will not work on a everyday basis. You have to give it time. But if your selection is proper, hopefully you can get better than average. If you are someone who says, I don't want all this jhamela, I want to just put it and forget it, and I'm happy with the average returns, index fund is good.
So they say that India has cost 2,000 plus per capita. And they say that, economic models in the past have said that if a country can cross 2,000 per capita, there's a huge scope and there's a huge leap after that. And 10 years of the current Indian economy looks very promising. You want to add something?
Overall, I think that's correct. So I'm very optimistic on the prospects of India. So we have young population, education levels are improving, physical infrastructure is improving, social infrastructure is improving. So social infrastructure in terms of education, healthcare, and whatever else there is there. So it will be positive on a whole. Given this backdrop, one has to be selective where we invest from a investment perspective. The second point to note is that averages sometimes can be misleading. So like it is said that someone asked what is the depth of the river, and he was told the average depth of the river is 3 feet. This person, 3 feet I can easily cross, and that person drowned. Now average depth may be 3 feet, at places it may be 6 inches or even 1 feet, and some places it may be 12 feet deep. So average could hide a lot of things. So when we talk about average GDP per capita, if you have listened to Mr. Manish Chokhani, he talks about this. So within India you have Singapore and Manhattan also, and you'll have a sub-Saharan Africa also, and you'll have a Mexico also. So some segment of the population is already living at maybe 200,000 GDP per capita, and some people will still be living on $3-4 a day. So one has to segment it and really figure out. So again, people talk about all these things about large population, addressable market. What most people in the startup phase or in the creating these new age businesses have figured out, roughly there are 6 crore people out of 140 who are really breaking out and consuming, and they are there everywhere. They are the people who are buying mutual fund units. They are the people who are buying cars and SUVs. They are people who are ordering food on the food delivery apps. They are the people doing e-commerce shopping. They are the people taking flights, going abroad on holidays. So one has to really take each product or service, figure out the pyramid. The good part is that pyramid is now becoming of a different shape. So at the bottom, the people are shrinking, and in the middle, that bulge is coming out. So in the future years, I think the middle class will grow significantly, but one has to take averages slightly cautiously. That's
So your view of the pharma and the hospital present.
So, sir had asked this question about inequality and things like that. Hospital, again, there's this constant challenge whether hospitals should be run as a for-profit or should there be a social angle to it. And for some time, society and government allows a for-profit operation to run. But if there are 1 or 2 or 3 very, very vivid cases where things go wrong, then suddenly there's a big clamp down. So I'm always a bit cautious as far as the domestic pharma and domestic hospital business goes. In fact, there's a case pending at Supreme Court relating to hospitals, which talks about capping the prices of each procedure. So if you have a knee replacement, this should be the maximum permissible. If there's a angioplasty, then this should be the maximum rate. Again, there have been cases where the actual cost of a stent is different and what the patient is charged is completely different. So it's under constant glare of the public regulators, and sometimes rightly so. So I was attending the investor session where the CEO of a private sector hospital, I'll not name which one, but this CEO was so articulate and so polished and all of that, but all that he was talking was profits, 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 and somewhere the message came across that profit is largely the only motive, and the cost to the patient or that does not rank very well in their scheme of things, and it may not be such a sustainable model. As far as pharma goes, already we have this thing where doctors should prescribe the medicine, generic medicine name rather than a brand name, which again is not that great from a profit perspective, but pharma exports, it's a good opportunity. So we have capability of manufacturing pharma or manufacturing drugs at a very low cost, and we have a good export share. That is a promising piece. API also, so yeah, at one point in time we had a thriving API industry. Over the years we lost out and said imports are cheaper, why bother making the bulk drugs, and let's just import the APIs. But now again the world is going in a reverse direction where everywhere there's emphasis on domestic manufacturing. So one after the other we are trying to bring back API.
One question. What's your view on this AI? Sector impact?
So in AI, among the biggest beneficiaries in the last 12 to 24 months have been people who are creating these models and people who are providing infrastructure to these. So the chip manufacturers have had a fabulous time, people like NVIDIA and all. And the people making those models, so Microsoft, Google, OpenAI, of course, as such is an unlisted entity, but they have partnerships with Microsoft. Going forward, these models have to be incorporated into the day-to-day work structures of people. So the existing players will continue to benefit, chip manufacturers or the large cloud providers and all those people will continue to benefit. But even IT services people who will try to integrate these tools into the corporate workflow or into businesses, those people will also benefit.
Big round of applause for Mr. Thakker. So it's a wonderful insight across all sectors. Most people will definitely be happy with whatever thoughts Mr. Thakker has given. And please do invest. That's the only thing we say from this forum. Not any particular mutual fund, but do invest. That's the right thing to do. Okay, so just to give a brief, we'll be having our annual Limay Memorial Lecture. We are speaking to Mr. Navneet Munot of HDFC or Mr. Avinash Satolekar of Franklin Templeton. So as soon as we have some solid information, we will definitely let you know. So just to give you a brief, annually once we have the annual Limay Memorial Lecture, so we have speakers. We had Mr. Saurabh Mukherjee who was here, we had Mr. Y.M. Devastadi who was given a lecture, and various other people from. So that's our annual, very shortly we'll let you know the details about that. And do you have any sessions this month? So we don't have any sessions this month because most of them will be on holidays very shortly. As it is, people, whether FIS or India, don't like to work after 20th of December. Because holiday starts on, I think this Friday is the last schooling day for all children. So then we'll see you in January and we'll update you with the annual Limay Memorial Lecture. So once again, thank you Mr. Thakker for the wonderful insight.